Hey friends, welcome back to my YouTube channel. NIMs, NII, gross NPA, net NPA. So many factors while analyzing a lender. How should you analyze a lender? Today in this video we are going to discuss how to simply analyze a lender. What are the key factors that you need to watch out for? Why management is a very important point while analyzing a lender, and what are the key points that most analysts miss while analyzing a lender objectively. So it is going to be a very interesting video by the end of which you will be objectively able to see yourself how to analyze a lender. So before we start, do subscribe to my channel and hit the like button on this video so that we can share such interesting insights with all of you. So let's start off with what does a bank really do. Very simply put, people deposit money in the bank and the bank gives onward loan to people. So the spread between the loans that the bank gives out and the deposit and the interest rate on the deposits is the money that the bank really makes. That is the main source of money that a bank really makes. As you can already see on the screen, interest earned on the loans minus interest paid on the deposits is net what the bank really earns. Let's take for an example, Kotak Mahindra Bank borrows at about 3.8% and gives out loans at about 9%. So this spread that the bank really makes is the income of the bank. There are two other sources by which a bank makes money. It sells a lot of financial products such as mutual fund, insurance and all sorts of other products. The commission that it gets from all of these products is the other income of the bank. But the core business of a bank is to take deposits and give out loans, and the spread between these two is the core earning of a bank. Now let's come on the second important point. What is an asset and a liability for a bank? Most people get very confused about what is an asset and a liability for a bank. For a bank, the interest paying loans are an asset. When these interest paying loans do not pay an interest, they are no longer considered as an asset. Any investment that a bank really makes in Government of India securities or with the Reserve Bank of India is an asset for a bank. What is a liability for a bank? The deposits which people give to a bank is a liability because the bank will have to pay those deposits anytime the deposit holder wants it. So it is a liability. Any money that the bank has borrowed from the bond markets or from other banks are all liabilities of a bank. So understanding the asset and a liability for a bank is very crucial in the analysis. Now let us understand the structure of a bank. The structure of a bank in India is designed in such a way that the RBI protects the interest of the deposit holders. So what has the RBI done? Out of every 1,000 rupees that a deposit holder deposits in a bank, RBI asks the bank to maintain a cash reserve ratio and a statutory liquidity ratio. So what do these ratios really mean? These mean that both of these investments are parked in very liquid assets and can be withdrawn at any time the Reserve Bank wants if the bank is in a problem. So we have seen that the CRR ratio in India is about 4%, which means that out of every 1,000 rupees, 40 rupees is to be parked with the Reserve Bank of India, which it can use to safeguard the deposit holders of the bank. Similarly, SLR securities are very liquid securities which could be Government of India debt or state government debt where banks will park money. This is about 18% of the bank's capital and these are parked in safe securities. So nearly about 22% of a bank's capital is put in a very high quality asset. Because these assets are very high quality, the return on all of these assets is very low. Now let's start off our analysis. The first important point is cost of funds. What does cost of fund really mean? A bank borrows money from the deposit holders, from bond holders and from other banks. So the blended cost at which a bank borrows from the public and all other sources is called the cost of deposits. Cost of deposits is very important and is the raw material for a bank. It dictates at what interest rate the bank will give future loans. As you can see on the screen, for all top banks, this cost of deposit is anywhere between 3.6% to 4.31%. These are very low cost of deposit and these are even lower than the repo rate or inflation. This means these top banks have got a massive advantage over all other banks. The second point that we need to discuss is the yield or the interest that a bank gives out on the loans. The blended interest rate is a very important factor while analyzing a bank. If the interest rate is very high, it means that the bank is carrying high risk on its books, and during downturn a lot of those loans could turn out to be NPAs. As you can see on the screen, we have shown the blended yield of top banks, and you can see that the yields are very low. They give out loans on an average from 8.1% to 8.9%. So theoretically, these banks carry the lowest amount of risk on their books because the interest rates at which these banks are really lending are really very low. Now let's come on the next important factor, the types of loan. There are two types of loan. One is a secured loan and the other is an unsecured loan. As the name suggests, a secured loan is backed by a security, whereas an unsecured loan is not backed by anything. A secured loan has a lower interest rate and a lower risk. An unsecured loan has a higher interest rate and a higher risk. What are the examples of a secured loan? Home loan, car loan, loan against property. These are all backed by a collateral and therefore are known as a secured loan. What are unsecured loans? Personal loans, credit card loans, micro loans, all of these are unsecured loans. These carry very high risk for the bank because of the fact that if they turn into an NPA, bank does not have any collateral from which it can recover money. NPA. क्या है ये NPA? Gross non-performing assets and net non-performing assets. So what really happens is bank gives out loans to its borrowers and the borrowers pay EMI every month. But sometimes some borrowers do not pay their EMIs timely, and there starts the problem. The Reserve Bank of India is very strict in classification of those borrowers who do not pay their EMIs on time. Once a borrower does not pay an EMI on time, as you can see on the screen, they are classified into a special mention account. RBI has strict rules to classify them. If an account has not paid interest from 0 to 30 days, it is known as an SMA 0 account. If they have not paid an interest from 30 to 60 days, it is known as an SMA 2 account, SMA 1 account, and if they have not paid an interest from 60 to 90 days, it is known as an SMA 2 account. So these are special mention accounts where bank has to give extra concentration in order to recover their loans. But what happens if the borrower does not pay interest even after 90 days? Then they are classified as a non-performing asset, a gross non-performing asset on the books of a bank. Every bank is then required to set off some portion of their profits for provisioning against these gross non-performing assets, and as these non-performing assets continue to keep moving up, the profits of a bank get depleted. As you can see on the screen, RBI is very strict on provisioning of these gross non-performing assets. As unsecured loans do not have any collateral, the provisioning norms for them are higher. Once an account turns substandard, anywhere between 15 to 100% of the entire loan needs to be provided. So for example, if a bank gives out 100 rupee of loan and the loan turns out to be an NPA, the borrower does not service the EMI, the bank will have to provide anywhere between 15 to 100 rupees more in order to provide for the NPA. So what really happens? Bank not only loses the 100 rupees of loan, it also loses another 100 rupees, which is why banking is a leveraged business and you should be very careful while analyzing a lender. Now let's come on to the most important factor and the juiciest part of this analysis. Management is one of the most crucial factors while analyzing a bank. Uday Kotak is one of the richest bankers not only in Asia but across the world. Here are 2 to 3 examples of how he's led Kotak Mahindra Bank since 2008 to greater heights. Let us look at the first example. Back in 2011, Uday Kotak makes it absolutely clear that Kotak Mahindra Bank will not lend to the infrastructure sector, the airline sector or the telecom sector. So what really happened is, all through 2010s right up till 2018, many NPAs came out of this sector. Famously, Kingfisher Airline, Reliance Communication and many infrastructure projects turned out to be an NPA, which hit banks like ICICI Bank. But Kotak Mahindra Bank was saved from all of these NPAs because Uday Kotak had a very clear vision that he would not like to lend to assets where cash flows are a big problem. So management strategy is exemplified by lending. Then let's come on to the second most crucial decision that Uday Kotak took. In 2013, he clearly states that he has learned from his mistakes in 2008 and he will not only lend to unsecured book but will build a mix of secured and unsecured book. He likes the unsecured book because in times of NPAs they have a collateral from which they can recover the money that they have paid. So building a mix of secured and unsecured book was another crucial step that Uday Kotak really took, which really helped Kotak Mahindra Bank tide through all of these crises. Then in 2016, Uday Kotak makes it absolutely clear that he will not restructure loans. If he finds that any loan is turning out to be an NPA, he will directly not restructure and slip it into NPAs. So what really happens here is, the bank is not really trying to hide NPAs and is trying to show the true asset quality to its investors. From 2014 right up till 2016-17, we've seen ICICI Bank and Yes Bank trying to hide the asset quality by restructuring loans. But in case of Uday Kotak, none of that was really happening and he tried to show the true asset quality to the investors. This reinforced the faith of the market on Uday Kotak, and Kotak Mahindra Bank started to trade at valuations as high as 6 to 7 times price to book. So now what you should do while analyzing a lender objective? The first crucial point that you should analyze is the management. The strategies employed by the management play a very important role. Is the management lending to questionable sectors? For example, right now the gems and the jewelry sector or the real estate sector, those are very questionable sectors. Is the management maintaining a mix of unsecured and secured book? Growing too fast in the unsecured book can also be a problem, because in times of NPAs it could be hard to recover from the unsecured book. Having a balance between unsecured and secured book is a crucial factor in building a high quality bank. The last factor while analyzing a management that you need to clearly figure out is the management trying to hide NPAs? If the restructuring book is really high, then it is a problem. If the write-offs that the bank is really taking is really very high, then it is a problem. These are all factors that you can figure out very easily from the investor presentations and by interacting with the management. And once you do this, you will realize which are the good managements and which are the not so good managements. The second most important factor is, as I have already discussed, cost of funds. Large banks have a superb franchise, superb brand and low cost of funds. Low cost of funds is an inherent moat in the business and helps you to lend to lower risk category borrowers. As you can see on the screen, large banks and small banks cost of fund has been shown here, and we've seen that the large banks borrow anywhere below 4%, whereas the smaller banks borrow anywhere between 5 to 6%. As these banks borrow at a higher interest rate, they are forced to lend at a yield of 14, 15, 16%. So the yield of 14, 15, 16% is not bad, but what I am saying is the risk on the books is much higher than the risk on the books of a large bank, which could be an SBI or a Kotak or an HDFC or an ICICI. The risk on IDFC First Bank or a Federal Bank could be much higher. As I have already said multiple times, the split between secured and unsecured book is very important. A good bank will try to grow in both directions, not only in one direction. Unsecured book, although it comes at a very high interest rate, it also carries its own risk. In bad times, a bank will tend to slow down its unsecured book and try to grow its secured book. On the unsecured side of it, they will prudently grow and not grow by 30, 40, 50%, which could lay down the seeds for future NPA. As you can already see on the screen, RBL Bank grew its unsecured book very aggressively. Nearly 67% of their book was in credit cards and microfinance in 2018, and as all of these sectors were hit badly due to COVID and IL&FS crisis, we saw a huge surge in NPA, and because of this huge surge in NPA, the bank was nearly bankrupt. So a good bank will never try to take undue risk on their book and try to maintain a split between secured and unsecured book. So what is the conclusion? How you should analyze the bank? Forget about analyzing the NIM, NII and obsessing about all of those factors. Look at the honesty of the management and the strategies adopted by the management. A good management will always be honest. They will tell you the true picture of the ground as well as of the bank. The strategies adopted will be prudent, excessive growth anywhere will not be found, and NPAs will not be avoided. NPAs will be shown as they are, and the bank will not try to restructure loans. Cost of funds and yield on advances is one of the biggest factors that shows you the amount of risk that you can see on the books of a bank. Lower the yield, lower the risk on the book, higher the valuation you can pay for a bank. Higher the interest rate that the bank carries on their books, lower the valuation that you should pay for the bank. You should look at the growth areas of the bank, secured, unsecured, as I have already said to you. The management should not try to hide NPAs, and the restructuring book should be really very low. So these are all the important factors that you should be looking while analyzing a bank. In the coming videos, we will start off with large private sector banks, then small private sector banks and PSU banks, where we analyze all of these lenders objectively and tell you what are the things that you should be really watching. Thank you for watching this video, and stay tuned for interesting insights on all of the sectors going forward.